Hey guys, thanks for clicking on this video. Today we're going to be looking at GameStop, but we are not going to be talking about its price because it is the weekend. We are going to be looking at this DD that I found on Reddit, and this is to do with margin debt peaked in June and the bull market is nearing its final hour. So why is this important? Well, we have long speculated, people on YouTube and Reddit have speculated that the coming market crash could cause the MOASS and vice versa, that the MOASS could cause the coming market crash. So, what is this DD here? Well, with the release of July's margin debt numbers, it's a reliable market indicator, and is pulling bears out of hibernation. A little background: margin debt is used as an indicator to gauge investor euphoria and risk, and both have reached astronomical levels. As you know, margin debt is using leverage to buy more stocks. Say you have 100,000 in your trading account and your broker offers 2-to-1 leverage, you can now buy 200,000 pounds worth of stock. When Archegos went down in late March, they were using around 10-to-1 leverage from several different banks, increasing their margin level. Increasing levels of margin debt are a good sign for a bull market. More money is entering the market, and this pushes the prices higher and higher. This becomes a problem when the margin debt begins to unwind. So here's some historical data. At the start of 97, we were into the boomer bull market that began in 1982 and approaching the start of the tech bubble that shaped investors' sentiments for the second half of the decade. An astonishing surge in leverage in 1999 peaked in March 2000, the same month that the S&P hit the all-time daily high, although the highest monthly close was for although the highest monthly close for that year was 5 months later in August. A similar surge happened in 2006, peaking in July '07, 3 months before the market peak. Debt hit a trough in February 2009, a month before the market bottom in March, and it began then it began another major cycle of increases. So here is a graph of margin debt in the S&P 500. So we have margin debt in red, the S&P 500 in blue, and then recessions in the grey. So you can see the relationship there between margin debt and then the coming recession, margin debt, recession, margin debt, recession, and now once again margin debt with a potential recession oncoming. It is evident that margin debt always peaks a few months before the market crashes, and seeing that we are at an astronomical level of leverage, we could see a crash worse than '08. Today's numbers: FINAR typically releases the market margin debt 2 to 3 weeks after the month is ended. For 15 straight months, the margin debt has continued to increase to record highs, and in June it hit 800. Well, I want to make sure I get this number right. Sorry, 882 billion, 103 million dollars. It is worth noting the June levels were also record high when compared to the US GDP. The margin debt after the month of July is 844 billion, with a change of around about 4.3%, minus 4.3%, sorry. While this may be a slight dip, a continuous unwinding leverage is a disaster for the market. What does that mean for apes? Market goes down, GME goes up, margin call begins, MOASS, apes retire early. These are the pictures I recommend you looking at, so let's just open up number one first. Okay, yes, I did see this. This link is actually broken, so apologies for that. I'll have to see what's happening there. And if we look at number two, this is stock market indicators margin debt. It is a long document, well, not long document, 7 pages. And you can see here we have different graphs showing out the margin debt. So I would say look at this in your own time. I'll leave the links down below. So too long didn't read. When margin debt goes up, more money into the market, stonks go up. When the market is down, when you leave the market, stonks go down. Margin debt go down by 4.4% from June, July. Market crash in a few months is what they're speculating here. So they're speculating in the very short term. So yearly percentage change in margin debt. This is one of the charts that we showed before. You can see these are the percentage change, high to low, very high. And it looks like it's on its way down as well. And you can see the recession happened just after that. Since the second figure here is the most important, it seems that a peak of at least 55% year-to-year changes signifies the top of the market. Since the 1970s, there have been 4 instances where year-over-year change was over 55% or greater. These were May 1972, up over 55% over a year. January 73, S&P peaks and recession begins lasting until 75. 1999, margin debt up by almost 60% year over year. March 2000 was the dot-com bubble burst, of course, and 2007 margin debt up 65%, and then October it peaks and the recession begins in December. The fourth case was in 83, where it was 55% increase, and this later corrected. Had a market correction of 15%, but was not considered bear market territory. So there are some other examples, and here we are. Here is the data here. So we are definitely in not as high as 2000, funnily enough, but at a pretty similar level to 08. So very interesting stuff. I just want to say I will leave the links down below. This is by a user called nmorgan81234. So please check out him, and he's brought some very interesting DD and another excellent perspective here. So I just want to say thanks for watching, guys. Please leave a like on the video, and I'll catch you guys next time.